There is a silent killer in the world of wealth and achievement. It's an enemy that masquerades as a virtue, a poison that we are told to drink as if it were a tonic. This enemy is activity. We are told from our first day in school to our last day in the boardroom that we must be busy, we must hustle, we must grind, we must constantly be making moves, sending emails, taking meetings, placing trades. The world worships at the altar of action, believing that the more we do, the more we will achieve. But what if this is a catastrophic lie? What if the single greatest advantage in business and investing and in life is not the discipline to do more, but the almost superhuman discipline to do nothing at all? What if the secret to building monumental wealth isn't found in the frantic energy of the trading floor, but in the profound stillness of an old man's office in Omaha, Nebraska? For more than 60 years, Warren Buffett has been engaged in a quiet rebellion against the cult of action. He has built a financial empire of nearly $1 trillion not by doing 1,000 things, but by doing a handful of things with absolute, earth-shattering conviction. His entire philosophy can be distilled into a single, revolutionary idea: selective inaction. It is the practice of treating activity as a cost, not a benefit. It is the understanding that your time, your energy, and most importantly your capital, are finite and precious resources to be guarded with the ferocity of a dragon protecting its hoard. This isn't about laziness, it is about becoming a predator. A predator does not run around the jungle all day hoping to stumble upon its prey. It waits, it conserves its energy. It observes, it studies, and it waits for the one perfect moment, the fat pitch, the unmissable opportunity, and then it strikes with overwhelming, decisive force. The modern world is designed to destroy this mindset. Your phone buzzes with notifications, demanding your attention. The stock market ticker flashes green and red, daring you to react. Your competitors announce a new product, and the pressure to respond is immense. This is the siren song of the action bias, a deep-seated psychological urge to do something in the face of uncertainty, even if that something is wrong. It makes us feel in control, productive. But in reality, it is the engine of our own destruction. It leads to impulsive trades, ill-conceived business strategies, and a portfolio bled dry by 1,000 tiny cuts of commissions and bad decisions. This journey we are about to embark on is a direct antidote to that poison. We are going to deconstruct the operating system of the world's greatest investor and hand you the source code. This is not a collection of stock tips. It is a fundamental rewiring of your approach to decision-making. We will explore 5 pillars that form the bedrock of Buffett's philosophy of selective inaction. We will see how he cultivated a temperament that made him immune to the market's manic depressive swings. We will learn his punch card philosophy, a rule so simple and so powerful, it can forever change how you allocate your capital. We will adopt the predator's mindset, learning to hunt for opportunities in the midst of chaos. We will master the art of sitting on cash, turning it from a lazy asset into your most powerful weapon. And finally, we will build the architecture of certainty, the circle of competence, that allows you to act with supreme confidence when the moment arrives. This is not a lesson in finance, it is a lesson in power, the power that comes from stillness, the power that comes from patience. The power to build lasting financial freedom by understanding that in a world that screams "do more," the ultimate advantage is the discipline to wait. Chapter 1: The Cultivation of Temperament over Intellect. Before we can even begin to talk about investment strategy, about balance sheets or market cycles, we must start with the single most important variable in the entire equation of wealth creation. It is not intelligence, it is not a prestigious degree, it is not access to secret information, it is temperament. It is the ability to remain rational when everyone around you is losing their mind. Warren Buffett has said it himself, The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. This is the foundation upon which his entire empire is built. It's the ability to divorce your emotional state from the short-term fluctuations of your environment. Without this, even the most brilliant financial analysis is utterly worthless, because it will be abandoned at the first sign of trouble. The market is a machine for transferring wealth from the active to the patient, and patience is not an intellectual quality, it is an emotional one. To understand how deeply this is ingrained in Buffett's DNA, we have to go back to the very beginning, to his early partnership days, when a young, unknown investor from Omaha had to prove to his partners, his friends, his family, his neighbors, that his strange, inactive philosophy was not a path to ruin, but to riches. Imagine it's the early 1960s. The post-war boom is in full swing, but the stock market is a volatile beast. Warren Buffett is in his early 30s, running Buffett Partnership Limited from a small home office. His investors are not Wall Street institutions. They are doctors, lawyers, and business owners from Omaha. They have entrusted him with their life savings. In his annual letters, Buffett didn't just report numbers. He educated his partners on his philosophy. He was laying the groundwork for the inevitable storms ahead. In 1962, the market experienced a brutal downturn known as the Kennedy slide. Speculative stocks that had soared in the preceding years came crashing down. The Dow Jones Industrial Average plunged nearly 30%. Fear gripped Wall Street. The consensus was to sell, to get out, to preserve what little capital was left. For a young money manager, this was the ultimate test. His partners, reading the terrifying headlines in the Omaha World Herald, were understandably nervous. They were watching their net worth evaporate on paper. This is the moment where most managers would feel the immense pressure to act, to sell certain positions, to de-risk, to buy others, to reposition, to do something to show their clients they were on the case. This is the action bias in its purest form. But Buffett did something extraordinary. He did almost nothing. He didn't panic sell. Instead, he wrote one of his now famous letters to his partners. He didn't offer platitudes or false promises of a quick recovery. He did the opposite. He calmly and rationally explained that such declines were a normal, recurring feature of the market. He reminded them that they were not owners of flashing ticker symbols, but of fractional stakes in real businesses. He wrote, "The market is there to serve you, not to instruct you." He explained that the drop in prices hadn't made their underlying businesses any less valuable. In fact, it was making other two businesses cheaper, creating future opportunities. He was a pillar of stability in a sea of panic. In one letter from that era, he laid out his core belief, stating that their investment results would be determined far more by the behavioral or temperamental advantage they held over the crowd than by any intellectual edge. He was managing his partners' emotions as much as he was managing their money. He knew that if he could get them to master their own fear, to resist the urge to act on that fear, they would be unbeatable. While others were frantically selling shares in wonderful businesses at foolish prices, Buffett was calmly looking for bargains, using the market's panic as his servant. This emotional control, this steadfast refusal to be governed by the crowd's hysteria, allowed him to not only survive the crash, but to lay the groundwork for spectacular returns in the years that followed. He was proving, in real time, that the victory is won not in the flurry of trading, but in the quiet discipline of the mind. This was not just a theory, it was a real-world application of a deep understanding of human psychology. The force that Buffett was battling in 1962, and that every investor battles today, is a flaw wired deep into our cerebral hardware. It is the action bias, a cognitive glitch that compels us to favor action over inaction, even when there is no rational evidence that doing something is better than doing nothing. From an evolutionary perspective, this makes perfect sense. If our ancestor heard a rustle in the grass, it was far better to run, action, than to sit and analyze whether it was a predator or just the wind, inaction. The cost of a false positive, running for no reason, was minimal, while the cost of a false negative, being eaten, was absolute. This do-something instinct is burned into our DNA, but in the modern world of investing and executive decision-making, this instinct is a catastrophic liability. The stock market is not a saber-toothed tiger. When it flashes red, running is often the worst possible response. Your brain, however, doesn't know the difference. The financial news media acts as a powerful catalyst for this flawed instinct. Every headline is crafted to provoke an emotional response, fear or greed. Market plummets on rate hike fears. This stock is the next Amazon. These prompts trigger the amygdala, the primitive emotional part of our brain, leading to what psychologists call an amygdala hijack. The amygdala screams danger or opportunity and floods your system with cortisol and adrenaline, effectively shutting down the prefrontal cortex, the rational, analytical part of your brain responsible for long-term thinking and impulse control. In this hijacked state, you are not an investor. You are a bundle of primal reactions. You sell at the bottom because the fear of further loss is overwhelming. You buy at the top because the fear of missing out, of watching your neighbors get rich, is unbearable. The action bias convinces you that making these moves is a form of control, of taking charge. In reality, you are ceding control to the most primitive, least intelligent part of your brain. Buffett's genius is his conscious, deliberate system for overriding this hijack. His temperament is not an accident of birth. It is a carefully constructed fortress against the psychological weaknesses that derail 99% of market participants. He has trained his prefrontal cortex to remain in command, to treat the market's manic screams not as instructions but as interesting and often useful data. He consciously creates distance between the stimulus, market news, and his response, allowing his rational mind the time and space it needs to make a sound judgment, a skill essential for anyone aspiring to a CEO mindset or effective money management. So how do we, who are not the Oracle of Omaha, build this fortress? How do we translate this theory of emotional control into a practical, applied mental model? The first step is to recognize that temperament is a skill that can be trained, not a trait you are born with. It requires a deliberate, structured approach. Let's call it the temperamental conditioning blueprint. The first tool in this blueprint is the asterisk step pre-commitment contract. Before you ever buy a stock, a piece of real estate, or make any significant capital allocation decision, you must write down, on paper, the exact conditions under which you would sell it. Be brutally specific. Is it if the company's fundamental economics deteriorate? If management is found to be dishonest? If the stock reaches a specific, pre-calculated valuation that you believe is irrational? You must also write down what you won't sell for. A 20% market correction, a scary headline in the Wall Street Journal, or a bad quarter of earnings. This document is a contract with your future, more emotional self. When panic strikes, and your amygdala is screaming, "Sell," you pull out this contract. It acts as a circuit breaker, forcing your rational brain back into the driver's seat. The decision was already made when you were calm and clear-headed. Your only job now is to execute the plan. The second tool is the practice of asterisk negative visualization, NIMS asterisk, a concept borrowed from Stoic philosophy. Regularly take time to vividly imagine a catastrophic market scenario. Imagine your portfolio is cut in half. Feel the fear, the anxiety, the regret. Now, in that simulated state of distress, what would you do? Most people's gut reaction is to sell everything. But because this is just an exercise, you can analyze that impulse. You can see how destructive it would be. The goal of this exercise is to inoculate yourself against fear. By experiencing the worst-case scenario in a controlled environment, you desensitize yourself to it. When a real 20% or 30% drop occurs, it won't be a terrifying, novel experience. You've already been there in your mind. You have a plan. You've rehearsed your response, which is most likely to stick to your pre-commitment contract and perhaps even look for bargains. The third and final tool is creating a non-media and information moat, consciously design your environment to reduce emotional triggers. This means turning off the daily stock market news. It means deleting the stock tracking app from your phone's home screen. Schedule a specific, limited time, perhaps 1 hour on a Saturday morning, to review your portfolio and read business news. The rest of the time, you starve the amygdala of the sensationalized inputs it craves. This isn't ignorance, it's strategic disengagement. It creates the space for long-term thinking to flourish, a cornerstone of financial discipline. By implementing this blueprint, you are no longer a passive victim of your emotions. You are an active architect of your own temperament. To truly appreciate the power of this approach, we must shine a harsh light on its opposite, the path of the 99%. Let's create a character. We'll call him Active Adam. Adam is smart, successful in his career, and wants to build wealth. He believes, like most people, that success in investing is correlated with effort and activity. His morning routine begins with CNBC. He has multiple stock apps on his phone, with alerts for every twitch in his portfolio. He's in a group chat with friends where they share hot stock tips. Adam feels informed, engaged, and in control. But he is a leaf in the wind. One week, an analyst on TV makes a compelling case for a new technology stock. FOMO kicks in. Adam buys it near its 52-week high, without doing any deep research. 2 months later, the company misses its earnings estimate and the stock plummets 30%. The headlines are terrifying. His group chat is in a panic. The pain of the loss, a psychological phenomenon known as loss aversion, where losses feel twice as powerful as equivalent gains, becomes unbearable. Adam sells the stock, crystallizing his loss, telling himself he'll buy it back when things stabilize. A few months later, the Federal Reserve announces an interest rate hike. The market has a seizure. Adam, seeing a sea of red in his portfolio, decides he needs to quote to cash to protect himself. He sells his high-quality, long-term holdings. The market bottoms a week later and begins a sharp recovery. Adam, however, is paralyzed. The news is still gloomy. He's waiting for a clearer signal to get back in. That signal never comes. The market rallies 25% off its lows, and Adam is left sitting in cash, having sold at the bottom and missed the explosive recovery. Over the course of a decade, Adam's portfolio is a testament to the cost of action. It is churned by commissions, whipsawed by emotional trades, and eroded by bad timing. He works hard, he is constantly busy managing his money, but his results are mediocre at best. He has mistaken activity for progress. Adam is the embodiment of the 99%. His intellect is not the problem, his temperament is. He is a servant to the market's whims and his own emotional reactions, a stark contrast to the master who uses the market's foolishness as an opportunity. Adam's path does not lead to financial freedom. It leads to a cycle of anxiety and frustration. The financial consequences of this temperament gap are not theoretical. They are brutally, mathematically concrete. Let's look at the direct connection. Studies by Dalbar, a financial research firm, have consistently shown that the average investor dramatically underperforms the market itself. For example, over a 30-year period, the S&P 500 might generate an annualized return of around 10%, but the average equity fund investor earns closer to 6% or 7%. Where does that massive gap come from? It's not from bad stock selection, it's from bad behavior. It is the tangible cost of the action bias of selling during panics and buying back in after the recovery is already underway. Let's quantify it further. A study by J.P. Morgan Asset Management revealed the devastating impact of trying to time the market. If you had invested $10,000 in the S&P 500 at the beginning of 2003 and stayed fully invested for the next 20 years, your investment would have grown to over $64,000. However, if you missed just the 10 best days in the market over that entire 20-year period, just 10 single days out of more than 5,000 trading days, your final return would be cut in half, to around $29,000. Miss the 30 best days, and your return is barely positive. These best days almost always occur during periods of extreme volatility and fear, precisely when active Adam is most likely to be on the sidelines in cash. The temperament to stay invested, to do nothing during the storm, is not just a philosophical virtue. It is a multi-thousand-dollar decision. On a company's balance sheet, this principle manifests as stability. A company led by a CEO with a Buffett-like temperament doesn't chase fads, doesn't over-leverage in good times, and doesn't panic sell core assets in bad times. This emotional stability translates into a fortress-like balance sheet and a consistent, long-term strategy that crushes the competition over time. For an individual, mastering temperament is the single greatest lever for building wealth. It ensures you capture the market's long-term compounding power and avoid the self-inflicted wounds of emotional decision-making. It is the financial discipline that separates the high-net-worth individual from the crowd. It is the difference between a portfolio that grows steadily toward financial freedom and one that spins its wheels, generating nothing but taxes, commissions, and regret. Before one can learn how to invest, one must first learn how to behave. Chapter 2. The Punch Card Philosophy, the Power of Extreme Selectivity. Once an investor has forged the steel of their temperament, the next challenge arises. How do you translate that emotional discipline into a coherent and effective investment strategy? The world presents an infinite buffet of options, thousands of stocks, bonds, real estate deals, and private equity opportunities. The temptation is to sample a little bit of everything, to constantly be on the lookout for the next new idea. This leads to what Buffett's partner Charlie Munger calls diversification, a portfolio so broad and shallow that it guarantees mediocrity. To combat this, Buffett developed a mental model so simple yet so profound that it acts as a permanent filter against mediocrity. It is the 20-slot punch card philosophy. He famously said, "I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it, so that you had 20 punches, representing all the investments that you got to make in a lifetime. And once you'd punched through the card, you couldn't make any more investments at all. Under those rules, you'd really think carefully about what you did, and you'd be forced to load up on what you'd really thought about, so you'd do much better." This is not just a clever analogy. It is a complete system for decision-making that forces extreme selectivity, deep conviction, and a truly long-term perspective. It is the practical application of selective inaction. With only 20 punches for a lifetime, the bar for making a new investment becomes astronomically high. You are no longer looking for good ideas. You are waiting for the handful of truly great, near-certain ideas that will define your financial life. Every decision carries immense weight, an enormous opportunity cost. Using a punch on a mediocre idea means you forfeit the chance to use it on a spectacular one that might come along next year. This framework obliterates the desire for constant action. It makes you a connoisseur of opportunities, not a consumer of them. To see this philosophy in action, we must travel back to 1963, to one of the most bizarre financial scandals in American history, and witness how a young Warren Buffett used one of his precious imaginary punches to make one of the defining investments of his early career. The story is that of American Express and the great salad oil scandal. The stage was set by a company called Allied Crude Vegetable Oil, run by a swindler named Tino DeAngelis. His business was supposedly storing and trading vegetable oil. He leased a massive tank farm in Bayonne, New Jersey, and took out huge loans from various banks, using the stored oil as collateral. American Express, through a subsidiary, ran a warehousing division that would verify the contents of the tanks and issue receipts, which DeAngelis would then use to get his loans. The problem was, DeAngelis was a con man. His tanks were mostly filled with seawater, with only a thin layer of salad oil floating on top. He had created a massive, phantom inventory. In November of 1963, the fraud was discovered, and Allied Crude Vegetable Oil declared bankruptcy, owing its lenders an estimated $175 million, a colossal sum at the time. American Express, which had guaranteed the receipts, was on the hook. Wall Street panicked. The story was everywhere. How could a blue-chip company like American Express make such a catastrophic mistake? Investors dumped the stock in droves. The share price was sliced in half, falling from over $60 to $35. The consensus view was that the salad oil losses would wipe out the company's entire net worth. The fear was palpable. This, for Buffett, was the sound of opportunity. But he didn't act on impulse. He began his methodical, patient investigation. This potential investment had to be worthy of a punch on his card. He wasn't interested in the scandal itself. He was interested in the true, underlying earning power of the American Express business. Did the scandal permanently impair the company's core franchises, the traveler's checks, and the charge card? That was the only question that mattered. So he did what he always does. He left his office and did the scuttlebutt research. He went to banks in Omaha and asked them if they were still going to sell American Express traveler's checks. They all said yes, of course. They were the gold standard. He talked to friends and business associates, asking if they were going to stop using their American Express cards. They looked at him like he was crazy. The card was a status symbol, a vital tool for business travel. He visited restaurants and hotels, observing whether customers were still confidently slapping down that iconic green card. They were. What Buffett discovered was a massive disconnect. Wall Street was obsessing over a one-time, albeit huge, loss from a peripheral division. But the customers and vendors of the core business didn't care. The brand's power, its moat, was completely intact. He then did the financial analysis, concluding that the company could easily absorb the salad oil losses and that its underlying businesses were phenomenal, cash-generating machines. He realized the market was offering him the chance to buy a truly wonderful business for a foolishly cheap price, all because of a temporary, sensationalized problem. He had found his moment of near absolute certainty, so he acted with massive, disproportionate force. He invested 40% of the entire Buffett partnership's capital into American Express stock. It was the largest investment he had ever made. He had used one of his precious 20 punches, and he had made it count. Within a few years, the market came to its senses, the scandal faded from memory, and the stock soared, earning the partnership a fortune. This wasn't a gamble. It was the logical conclusion of a philosophy rooted in extreme selectivity and deep, independent thought. The psychological brilliance of the 20-slot punch card model lies in how it short-circuits several powerful cognitive biases that lead to poor decision-making. The first is the asterisk paradox of choice. Research has shown that when people are presented with too many options, they either freeze up and make no decision, or they make a shallow, less optimal choice because the cognitive load of evaluating every option is too high. The modern investment world is the ultimate paradox of choice. The punch card solves this by artificially constraining your options. It forces you to say no to 99.9% of ideas, freeing up your mental energy to go incredibly deep on the few that might qualify. It transforms the investment process from a frantic search for what's next into a patient wait for the unmissable. The second bias it combats is our tendency toward low-conviction, low-commitment decisions. When you can make unlimited trades, each individual trade feels insignificant. It's easy to buy a little bit of a stock based on a flimsy premise, and just as easy to sell it at the first sign of trouble. The punch card fundamentally changes this dynamic. Because each punch is so valuable, it raises the standard for entry. You won't use a punch unless you have a truly deep, almost unshakable conviction in the long-term prospects of the business. This, in turn, leverages a powerful psychological principle called asterisk commitment and consistency bias. Once we make a public, effortful, or significant commitment to something, we are far more likely to stick with it and see it through. By making each investment a punch, a major lifetime decision, you are psychologically priming yourself to be a long-term owner, not a short-term speculator. You are far more likely to weather the inevitable storms and volatility, because abandoning the position would be to admit a major, significant error in judgment on one of your precious 20 slots. This framework is a powerful tool for enforcing the kind of long-term thinking that is essential for building real wealth. So how can you apply this powerful mental model to your own financial life? You can conduct what I call the 20-slot punch card life audit. This isn't just about stocks. It can apply to any major capital allocation decision, buying a business, investing in real estate, or even significant career moves. The first step is to accept the premise. Imagine you are literally handed a physical card with 20 slots. This is all you get for the rest of your life. Internalize the scarcity of this resource. The second step is to set your impossibly high bar for what constitutes a punch. This is where you fuse the punch card idea with the concept of your circle of competence. Write down your strict, non-negotiable criteria. For example, I will only use a punch on a business I can understand inside and out. It must have a durable competitive advantage, or moat. It must be run by honest and able management. And I must be able to buy it at a significant discount to its intrinsic value, providing a margin of safety. These criteria immediately eliminate almost every investment idea that will ever cross your desk. The third step is to create a too hard pile. As you evaluate ideas, your default answer must be no. 99% of things go directly into the too hard pile without guilt or FOMO. An idea is too hard if you don't understand the technology, if the industry is too competitive, or if the future seems too unpredictable. Your job is not to have an opinion on everything. Your job is to identify the rare and easy pitch. The fourth and final step is the asterisk written thesis mandate. Before you are allowed to execute a punch, you must be able to write a 1 to 2 page memo detailing exactly why this opportunity is so extraordinary. Explain the business model, the moat, the valuation, and the primary risks. The act of writing forces clarity of thought. If you can't explain it simply, you don't understand it well enough. This process transforms you from a gambler into a business analyst. It replaces impulsive action with deliberate, high-conviction decision-making, the very essence of a professional investment strategy. The path of the 99%, the antithesis of this philosophy, is the path of the collector. The average investor, let's call her diversified Diane, believes that safety comes from owning as many things as possible. Her financial advisor has her in a dozen different mutual funds. She owns stocks from every sector. She has a little bit of crypto, a little bit of gold. Her portfolio statement is 20 pages long. On the surface, this seems prudent, but in reality, it's a recipe for mediocrity. Diane understands almost nothing that she owns. She owns a slice of the global tech fund, but she couldn't name its top 5 holdings or explain their business models. She owns a piece of the emerging markets fund, but has no real insight into the political or economic risks. Her diversification is an illusion of safety. It is, in reality, an admission of ignorance. Because she has no deep conviction in any single holding, she is susceptible to every market narrative. When tech is hot, she wants more tech. When financials are struggling, she wants to sell them. Her portfolio is constantly being churned, generating fees for her advisor and taxes for the government, but little in the way of alpha for herself. She is busy, she is active, but she is going nowhere. The punch card investor, by contrast, might only own 5 or 6 stocks. But they know those businesses as well as the CEOs who run them. They have deep conviction. This concentration of knowledge is the true source of safety and the only path to extraordinary returns. Diane is playing not to lose. The punch card investor is playing to win, and to win big. The direct financial connection between the punch card philosophy and building massive wealth is undeniable. It boils down to the simple mathematics of concentrated, long-term compounding. A portfolio of 100 stocks is, by its very nature, going to produce a return that is very close to the market average, minus fees. It's a mathematical certainty. You own a little bit of everything, so you get the return of everything. But exceptional wealth is not built by achieving average returns. It is built by making a few exceptional decisions. Look at the history of Berkshire Hathaway. Its monumental success does not come from hundreds of good investments. It comes from a handful of spectacular ones, the punches that truly mattered: American Express, The Washington Post, See's Candies, Coca-Cola, and more recently, Apple. Each of these was a high-conviction bet where Buffett loaded up, often committing a huge percentage of his available capital. His investment in Apple, for example, grew to represent nearly half of Berkshire's entire public stock portfolio. That is the polar opposite of diversification. Let's run a simple thought experiment. Investor A puts $100,000 into a portfolio of 100 stocks. Investor B puts the same $100,000 into just 5 stocks, putting $20,000 into each. Over the next decade, one of Investor B's stocks is a 10-bagger. It goes up 1,000%. The other 4 do okay, perhaps returning the market average. That single great decision, to which he allocated a significant 20% of his capital, will generate a return of $180,000 on its own, completely transforming the performance of his entire portfolio. For Investor A, even if one of his 100 stocks is a 10-bagger, it barely moves the needle. His $1,000 position becomes $10,000, adding a mere 9% to his initial capital. The punch card philosophy forces you to structure your portfolio like Investor B. It demands that when you find one of those rare 10-bagger opportunities, you bet big. This is how you generate the kind of returns that lead to true financial freedom. It requires courage, it requires deep research, and most of all, it requires the discipline to say no 1,000 times, so that when the perfect opportunity arises, you have the capital and the conviction to say yes with overwhelming force. Chapter 3: The Predator's Mindset: Hunting for the Fat Pitch. Patience, in the Buffett paradigm, is not a passive act. It is not the lazy, hopeful waiting of a fisherman staring at a motionless bobber. It is the focused, coiled, and potent patience of a predator. It is the lioness lying perfectly still in the tall grass, watching the herd, conserving every ounce of energy. She is not sleeping, she is hunting. She is ignoring the small, the weak, and the mediocre prey. She is waiting for the one perfect moment, the fat, slow wildebeest that strays from the herd, when a burst of explosive, decisive action will yield the maximum reward for the minimum risk and effort. This is the fat pitch philosophy, an idea Buffett borrowed from baseball legend Ted Williams. In his book, The Science of Hitting, Williams explained that the key to his success was not swinging at every pitch, but waiting for a pitch in his sweet spot. A pitch on the outside corner might be a strike, but he knew he could only hit it for a weak single. A pitch right down the middle, belt high, was the fat pitch he could hit out of the park. He had the discipline to let the marginal pitches go by, even if the umpire called them a strike. Buffett realized that in investing, this is the ultimate advantage. The stock market is a game with no called strikes. You can stand at the plate all day and watch thousands of pitches go by. Overvalued IPOs, complex derivatives, speculative biotech companies, and face no penalty. You don't have to swing. You can wait and wait and wait for that one perfect, juicy, slow-moving pitch right in your wheelhouse. When it arrives, and you know it's the one, you swing for the fences. This mindset transforms patience from a virtue into a weapon. It reframes market chaos not as a threat, but as a source of opportunity. To truly understand this predatory instinct, we must go back to one of the darkest days in modern market history, October 19, 1987, a day forever known as Black Monday. The morning of Black Monday, the global financial system seemed to be imploding. The Dow Jones Industrial Average plunged 508 points, a staggering 22.6% drop in a single day. It was, and still is, the largest one-day percentage loss in the index's history. The mood was not just fear. It was sheer, unadulterated panic. The nascent systems of computerized trading had created a cascading waterfall of sell orders. Margin calls were liquidating portfolios. The financial media was filled with images of shell-shocked traders on the floor of the New York Stock Exchange. The narrative was that this was the end of the bull market, perhaps the beginning of a new Great Depression. For 99% of investors, the instinct was clear and overwhelming. Sell, get out, run for the hills. The pain of watching your life savings get vaporized was too much to bear. But in Omaha, Nebraska, Warren Buffett was not panicking, he was hunting. The crash for him was not a crisis. It was a sale. It was the financial equivalent of a 50% off everything sign being hung on the front of corporate America. For years, he had been patiently studying one of the greatest businesses in the world, the Coca-Cola Company. He understood its simple, brilliant business model. He understood its iconic brand, a psychological moat that was virtually impenetrable. He saw its immense and untapped global growth potential. He loved the business, but for years, he had found the stock price too expensive. It wasn't a fat pitch. Black Monday changed everything. The crash had nothing to do with the number of people in the world who were drinking Coke. The fundamental business was completely unharmed by the chaos on Wall Street, but its stock price, along with everything else, had been bludgeoned. Suddenly, this magnificent, world-dominating business was being offered at a price that was not just fair, but cheap. The fat pitch was coming right over the plate. While the herd was stampeding for the exits, Buffett calmly and methodically started buying, and he didn't just nibble. Between 1988 and 1989, in the aftermath of the crash, Berkshire Hathaway invested over $1 billion into Coca-Cola stock, accumulating a 7% stake in the company. It was a massive, concentrated bet. He was swinging for the fences. In his 1988 letter to shareholders, he wrote with his trademark clarity, "We expect to hold these securities for a long time. In fact, when we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever." The result was one of the most successful investments in history. Berkshire's initial $1.3 billion investment in Coke would be worth over $25 billion today, not even counting the tens of billions in dividends received over the decades. This was the predator's mindset in its purest form. He used the market's extreme, irrational fear as his entry signal. The very chaos that paralyzed everyone else was the exact condition he had been patiently waiting for. The psychological forces that Buffett overcomes with this predator's mindset are two of the most powerful and destructive biases in finance: night loss aversion, and herd bias. Loss aversion, as we've discussed, is the principle that the pain of a loss is about twice as potent as the pleasure of an equivalent gain. When the market is crashing, loss aversion is screaming in your ear with a megaphone. Every tick down is a fresh wave of psychological pain, and the brain's only impulse is to make the pain stop, which means selling. It is an instinct for immediate relief that comes at the cost of long-term wealth. Herd bias, or social proof, is the deep-seated human instinct to follow the crowd. When we are uncertain, we look to others for cues on how to behave. In prehistoric times, if the herd started running, you ran with them. Not asking questions was a survival mechanism. In financial markets, it is a wealth destruction mechanism. When you see on the news that investors are fleeing to safety, every fiber of your being tells you to flee as well. To stand apart from the herd, to buy when everyone else is selling, feels unnatural, uncomfortable, and terrifying. It is an act of profound psychological defiance. The predator's mindset deliberately inverts these forces. It rewires your brain to interpret the signals differently. For the predator, the herd's fear is not a reason to run. It is the dinner bell. The pain of falling prices is not a threat. It is the signal that bargains are emerging. This requires a fundamental shift in perspective, from seeing the stock market as a barometer of economic truth to seeing it as a manic-depressive business partner. As Ben Graham, Buffett's mentor, taught him, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. The predator ignores the voting, the daily popularity contest driven by fear and greed. They focus only on the weighing, the true, underlying intrinsic value of the business. A market crash is simply the moment when the voting machine offers to sell you a dollar bill for 50 cents. The predator's only job is to have the cash ready and the courage to act. This emotional control is the ultimate arbitrage opportunity in modern markets. You can cultivate this predator's mindset through a disciplined, practical mental model, building your crisis watch list. This is not about predicting a crash, it's about preparing for one. The time to decide what to buy is not in the middle of a panic. The research must be done beforehand, during times of calm. The first step is to identify your dream assets. These are 5 to 10 truly world-class businesses that you understand deeply and would love to own, but which are currently trading at prices that are too high to be considered a, quote, fat pitch. These could be dominant software companies, unshakable consumer brands, or efficient industrial giants. The key is that they must be within your circle of competence. The second step is to do the work. For each company on your watch list, you conduct a deep and thorough analysis of its business model, competitive advantages, management team, and financial health. Your goal is to arrive at a conservative estimate of its intrinsic value per share. The third and most crucial step is to calculate your fat pitch price. This is not just a price that is slightly below intrinsic value. This is a price that offers a massive margin of safety, a price so attractive that buying it would feel almost like stealing. It might be 50% below your estimate of intrinsic value. This is a price that is only likely to be hit during a period of extreme market-wide or company-specific fear. The fourth step is to set your alerts. Use your brokerage platform or a financial data service to set automated price alerts for each of your dream assets at your predetermined fat pitch price. And then, the final step, the essence of the predator's mindset. You do nothing. You wait. You go about your life, building your career, saving your money. Months or even years may go by. You ignore the daily noise. Then, one day, the inevitable will happen. A recession hits, a geopolitical crisis erupts, or a flash crash occurs. Your phone will buzz with an alert. Company X, which you studied and valued at $200 a share, has just hit your fat pitch price of $100. At that moment, the world is in a panic. The headlines are screaming, "Sell." But for you, there is no fear. There is only clarity. The research is done. The decision has already been made. Your only job is to execute the plan, to swing the bat with conviction, and to buy a wonderful business at a price you could have only dreamed of a year earlier. This is how you transform market chaos from a threat into a servant. The antithesis to this patient, predatory approach is the path followed by the 99%, that of the market timer and the knife catcher. The market timer is obsessed with predicting the market's next move. They read charts, listen to gurus, and believe they can identify the top just before a crash and the bottom just before a recovery. They sell after the market has already dropped 10%, hoping to avoid the next 10% fall, but often find themselves watching in horror as it immediately rebounds 15%. They sit in cash, waiting for the perfect re-entry point, a point that only becomes obvious in hindsight. They are perpetually out of sync, selling too late and buying too late, guaranteeing they miss the most important turning points. The knife catcher, on the other hand, is a value investor without the discipline. They see a stock that has fallen significantly and assume it must be cheap. They rush in to buy what they perceive as a bargain, but they haven't done the deep research. They are, quote, catching a falling knife. They don't know if the company is a world-class business facing a temporary problem, like Coca-Cola in 1987, or a mediocre business with a fatal flaw whose stock price is heading toward zero. Both the market timer and the knife catcher are reactive. They are driven by the price action of the market itself. Their decisions are made in the heat of the moment, dictated by the very fear and greed they should be exploiting. They are the prey, providing liquidity to the patient predators who are waiting on the other side of the trade. The direct financial connection of adopting a predator's mindset is the capture of what can be called crisis alpha. Alpha is the term for returns generated above the market average, and there is no more fertile ground for generating alpha than during a crisis. Let's look at the hard numbers from the 2008 global financial crisis. From the peak in late 2007 to the bottom in March 2009, the S&P 500 fell by more than 50%. It was a period of absolute terror. An investor who was fully invested and simply held on, which required significant temperament, eventually recovered and did very well. But the predator who had been sitting on cash and deployed it near the bottom in early 2009 generated life-changing returns. From the low in March 2009, the market rallied over 60% by the end of that year alone. A stock like Apple, which was already a great business, could be bought for a split-adjusted price of around $3 per share in early 2009. That same stock would be worth over $200 today. That is the power of buying a great asset when there is blood in the streets. The predator mindset, combined with a crisis watch list, is a systematic way to position yourself to capture these generational buying opportunities. It is a core component of any serious money management or wealth-building plan. It directly monetizes the emotional irrationality of others. By learning to be greedy when others are fearful, you are not just reciting a catchy phrase. You are executing a definitive, quantifiable financial strategy that is one of the most reliable paths to achieving true, lasting financial freedom. Chapter 4: Mastering the Art of Sitting on Cash. Capital as Ammunition. In the modern financial world, cash is treated with contempt. It is called trash. We are constantly reminded that it is a depreciating asset, eroded by inflation, a drag on performance. The prevailing wisdom chanted by financial advisors and market pundits alike is that you must be fully invested at all times. To hold a significant amount of cash is seen as timid, unsophisticated, and a failure of capital allocation. Warren Buffett, however, holds a radically different view. He sees cash not as a liability, but as a strategic asset of immense power. He sees it not as a sign of fear, but as a position of strength. For him, a large pile of cash is not idle. It is coiled. It is ammunition. It is a call option with no expiration date on any asset in the world that may become mispriced. Mastering the art of sitting on cash, often for years at a time, while resisting the siren song of the market, is perhaps the most difficult and most contrarian aspect of his selective inaction philosophy. To understand the psychological fortitude this requires, we must travel to the height of the greatest speculative mania of our lifetime, the dot-com bubble of the late 1990s. The years from 1997 to early 2000 were a time of irrational exuberance. The rise of the internet had unleashed a speculative frenzy unlike anything seen before. Any company with a .com at the end of its name, regardless of its business model, revenues, or profits, saw its stock price soar to astronomical heights. Stories of 25-year-old instant millionaires were everywhere. Taxi drivers were giving stock tips. It was a classic speculative bubble. And through it all, Warren Buffett and Berkshire Hathaway were sitting on the sidelines. As the Nasdaq Composite Index rocketed up 100%, then 200%, Berkshire Hathaway was underperforming the market, and badly. The company was sitting on a mountain of cash, tens of billions of dollars, earning a pittance in short-term treasury bills. The pressure on Buffett was immense. He was publicly ridiculed. Barron's ran a cover story with the headline, "What's Wrong, Warren?" He was called a dinosaur, a relic from an old economy who just didn't get the new paradigm of technology. Shareholders were grumbling. The financial media openly questioned if he had lost his touch. Imagine the psychological weight of that. Every day, for years, You are watching others get fabulously rich in a game you refuse to play. You are being called a fool by the most respected financial publications in the world. Your own track record, your legacy, is being called into question. The temptation to capitulate, to just buy a little bit of Cisco or Intel to participate, must have been overwhelming. This is where temperament and philosophy are forged into steel. Buffett's reasoning was simple and unwavering. These new technology companies were outside his circle of competence. He couldn't, with any degree of certainty, project their cash flows out 10 or 20 years, and their valuations were based not on earnings but on eyeballs, clicks, and dreams. They were not fat pitches, they were wild, unhittable curveballs. So he patiently waited, holding his cash. In his 1999 letter to shareholders, he wrote with stunning honesty, "The reaction of weak-kneed CEOs to the swaggering of their more promiscuous peers is, in truth, not a pretty sight. I will not needlessly jeopardize the well-being of our owners by participating in activities that are beyond my competence or that I believe involve serious risks that are not adequately understood." Then, in March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a catastrophic collapse. Over the next 2 years, it would fall nearly 80%. Companies that had been worth billions went bankrupt. The paper fortunes of the dot-com millionaires evaporated. It was a scene of utter financial carnage. And in Omaha, Warren Buffett sat on his mountain of cash. His patience had been vindicated in the most brutal way imaginable. But the cash was not just a defensive tool that had protected Berkshire from the crash. It now became a formidable offensive weapon. While other companies and investors were ruined, leveraged, and desperate, Berkshire had liquidity. This liquidity gave him options. He had the capital to buy distressed assets, to provide financing to struggling companies on incredibly favorable terms, and to pick through the wreckage of the bubble to find the real, durable businesses that had been unfairly punished. The cash he was mocked for holding had transformed from a drag on performance into the single most valuable asset a company could possess. He had mastered the art of seeing cash not for what it earned, but for the opportunities it could command. The psychological demons that make holding cash so difficult are asterisks, pannotsus, pannots, fear of missing out, asterisks, and social proof. FOMO is a primal anxiety that others might be having rewarding experiences from which we are absent. In finance, it is the visceral pain of watching other people get rich while you are standing still. During a roaring bull market or a speculative bubble, FOMO is an epidemic. It short-circuits rational analysis. The internal monologue is not, "Is this a good investment?" but rather, "Everyone else is winning, I can't afford to be left behind." Social proof, its close cousin, reinforces this. When it seems like every expert, every news anchor, and all your friends are buying into a certain trend, your brain assumes it must be the correct thing to do. To resist this consensus is to risk being ostracized, to be the lone fool in a crowd of geniuses. Holding cash during a mania is a direct, public defiance of both FOMO and social proof. It is a declaration that you believe the crowd is wrong, a stance that requires immense self-confidence and a deep-seated trust in your own analytical framework. Buffett's perspective on opportunity cost is also a key psychological shield. Most people think of the opportunity cost of holding cash as the modest returns they are foregoing from stocks or bonds. Buffett thinks of it in reverse. For him, the opportunity cost of investing in a mediocre, slightly overvalued company today is forfeiting the ability to invest in a spectacular, deeply undervalued company that a future market crisis might offer. He is willing to accept a small, certain, short-term cost, underperforming in a bull market, in exchange for a massive, uncertain, but potentially life-changing long-term benefit, having the capital to strike during a panic. This reframing is essential. You are not losing by holding cash. You are paying a small premium for the most valuable option in the world, the option to act when others are forced to be passive. This is a core tenet of sophisticated capital preservation and a hallmark of a true CEO mindset. How can the average person apply this professional-grade strategy? You can implement a practical framework called the two-pocket money management system. This is a way to structure your personal finances to balance long-term growth with opportunistic firepower, a system for both investing and money management. Pocket 1 is your asterisk core compounding portfolio. This is the bulk of your investment capital. It should be invested for the long term in a diversified, low-cost manner that you don't touch. For most people, this could be a simple portfolio of broad market index funds. The purpose of this pocket is to harness the long-term growth of the economy and to build your base of wealth steadily over time. You contribute to it regularly, and you do not try to time the market with this capital. This is your fully invested at all times pocket, which satisfies the need to be in the game. Pocket 2 is your asterisk opportunity fund. This is your Buffett-style cash hoard. It is a separate account, held in the safest, most liquid assets available: cash, money market funds, or short-term treasury bills. The size of this fund is a personal decision, but it should be significant enough to matter, perhaps 10 to 25% of your total investable assets. Crucially, you must set strict, predefined rules for deploying this capital. This is not money for trading or market timing. This cash can only be used under two conditions. 1. A major market downturn, for example, if the S&P 500 falls more than 20% from its peak. 2. If a specific company on your pre-researched crisis watch list hits its fat pitch price. This two-pocket system is psychologically brilliant. It allows you to participate in the market's upside with your core portfolio, which helps combat FOMO. But it also institutionalizes patience by creating a dedicated pool of capital for which waiting is its primary stated purpose. It turns holding cash from a fuzzy, emotional decision into a clear, rules-based strategy. The antithesis of this disciplined approach is the fully invested at all times dogma, which is often preached with religious fervor. The proponents of this view argue, correctly, that over the long term stocks outperform cash. Therefore, any day spent in cash is a day you are likely missing out on returns. While mathematically true in the aggregate, this dogma is incredibly fragile in the real world because it ignores human psychology and real-life financial needs. Let's imagine an investor, leveraged Larry. He believes cash is trash. He is 100% invested in stocks and even uses a little bit of margin debt to amplify his returns. In a bull market, Larry looks like a genius. His portfolio is soaring, but when the inevitable 30% or 40% market crash arrives, his situation becomes catastrophic. Not only does his net worth plummet, but he faces a margin call from his broker, forcing him to sell stocks at the worst possible moment to cover his debt. He has no ammunition, no optionality. The market crisis has turned into a personal financial crisis. He is a forced seller at the exact moment the patient predator is looking to be a buyer. The fully invested dogma works perfectly in a spreadsheet simulation where the investor is a robot. But for humans who experience fear, who might lose a job during a recession, or who might face unexpected expenses, having a cash reserve is not a drag on performance. It is the shock absorber that allows you to survive the journey and stay in the game long enough to win. The direct financial connection of mastering the art of holding cash is what financial professionals call the asterisk value of optionality. In simple terms, cash is a call option on every asset class, with a strike price that is constantly fluctuating. When asset prices are high, the option is out of the money and not very valuable. But when asset prices crash, that same option becomes deep in the money and its value explodes. Let there be no clearer example than Buffett's actions during the 2008 financial crisis. The global financial system was on the brink of collapse. Credit markets were frozen. Institutions that had been pillars of Wall Street were either bankrupt or teetering on the edge. No one had cash. No one could lend. Except for Warren Buffett. Because he had maintained a fortress balance sheet and a huge cash pile at Berkshire, his phone started ringing. In the span of a few weeks, he was presented with opportunities that were literally once in a lifetime. Goldman Sachs, the premier investment bank, came to him desperate for capital to shore up confidence. Buffett invested $5 billion. But he didn't just buy common stock. He negotiated a deal for preferred stock paying a guaranteed 10% dividend, plus warrants to buy common stock at a fixed price in the future. It was an incredibly lucrative, low-risk deal that was only available because he had the cash when nobody else did. He struck a similar deal with General Electric. He bought billions in debt from Wrigley, the chewing gum company, to help them finance a merger. In each case, he was able to dictate incredibly favorable terms. These investments were not available to the general public. They were the direct result of his decades-long discipline of maintaining liquidity. Those 2008-era investments generated billions upon billions of dollars in profits for Berkshire Hathaway with very little risk. This is the ultimate financial manifestation of patience. The cash that sat earning nothing for years was suddenly deployed at rates of return that are almost unimaginable to the average investor, proving that the true return on cash is not measured by the paltry interest it earns, but by the price of the assets it can command in a crisis. This is a level of thinking that transcends personal finance and enters the realm of private equity and high-level executive decision-making. Chapter 5: The Circle of Competence, the Architecture of Certainty. The entire philosophy we have been discussing, the temperament to withstand panic, the selectivity of the punch card, the predatory patience to wait for the fat pitch, the discipline to hold cash, all of this rests upon one final, crucial pillar. Without this pillar, the entire structure collapses into a dangerous game of speculation. This foundation is the principle of the circle of competence. It is a concept so simple on the surface, yet so profound in its application. Warren Buffett and Charlie Munger have stated, time and again, that their success comes not from having a massive circle of competence, but from knowing its perimeter with absolute precision. Buffett explains it like this: you don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. This is the intellectual architecture that makes selective inaction possible. The only way you can have the conviction to do nothing when the world is going crazy, or to bet the farm on a single idea, is if you are operating from a position of near absolute certainty. That certainty is only achievable within the narrow confines of what you truly understand. A perfect illustration of this principle in action was not a flashy tech investment, but a profoundly simple and, to some, boring one: the acquisition of See's Candies in 1972. At the time, Buffett and Munger were looking to buy whole companies for Berkshire Hathaway. They were introduced to See's, a family-owned high-quality box chocolate company based in California. To many on Wall Street, this would have seemed like a pedestrian investment. It wasn't a high-growth technology company. It wasn't a complex financial instrument. It was just chocolate. But for Buffett and Munger, it was a business that fell squarely inside their circle of competence. They understood the product, they understood the customer. They could analyze its economics with a high degree of confidence. They flew out to meet with the See family and dug into the business. What they found was a commercial jewel. See's had a fanatically loyal customer base. People who grew up with See's chocolates at Christmas or Valentine's Day associated the brand with happy memories. This gave the company incredible pricing power. Every year, See's could raise its prices by a little bit to cover inflation and then some, and the customers would happily pay it because the quality was consistent and the brand was beloved. This was a powerful, intangible asset, a moat built of nostalgia and trust that didn't show up on the balance sheet. They saw a business that required very little new capital to grow. It gushed free cash flow. They could understand its future with a clarity that was impossible for, say, a semiconductor company. The business was simple, predictable, and had a durable competitive advantage. After some negotiation, Berkshire bought See's Candies for $25 million. At the time, some of Buffett's partners thought he had overpaid, as it was a significant premium over the company's book value. But Buffett and Munger weren't buying the book value, they were buying the brand, the pricing power, the moat. They were certain of its long-term value. That $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that was then used to buy other businesses. See's Candies became the prototype, the mental model that taught Buffett the immense value of buying a wonderful business at a fair price, rather than a fair business at a wonderful price. This monumental success was only possible because they had the humility and wisdom to operate strictly within the boundaries of what they knew, allowing them to achieve a level of certainty that their competitors, chasing more exciting but less understandable ventures, could never hope to match. The psychological trap that the circle of competence saves us from is one of the most insidious of all, the Dunning-Kruger effect. This is a cognitive bias, whereby people with low ability in a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. The world of investing is a playground for the Dunning-Kruger effect. A person reads a few articles about artificial intelligence, watches a few YouTube videos, and suddenly feels they are qualified to pick the winning stocks in the AI revolution. An investor makes money on one lucky crypto trade and starts to believe they are a currency expert. This overconfidence inevitably leads them to venture outside their circle of competence. They start making bets in industries they don't truly understand, using jargon they can't really define, and chasing narratives instead of analyzing businesses. They mistake familiarity with a topic for genuine expertise. A rigorously defined circle of competence is the ultimate antidote to this. It is an act of profound intellectual humility. It is the practice of saying "I don't know" 99 times out of 100. It replaces the arrogant desire to be an expert in everything, with the humble and far more profitable goal of being a true expert in just a few things. This humility is the bedrock of a sound investment strategy and prevents the kind of catastrophic errors that come from overconfidence. Building your own circle of competence is one of the most important intellectual exercises you can undertake. It is a process of honest self-assessment. The first step is to take an inventory of your knowledge. Get a piece of paper and draw 3 columns: professional expertise, hobbies and passions, and areas of genuine study. In the first column, list the industry you work in. You have a massive informational advantage here. You understand its dynamics, its key players, its economics, in a way an outsider never could. In the second column, list your deep hobbies. Are you a passionate gamer who understands the video game industry, a car enthusiast who knows the auto sector inside and out, a home cook who understands the consumer packaged goods space? These areas of passion are fertile ground for competence. In the third column, list subjects you have studied formally or informally for years with genuine interest. The second step is to apply a brutal honesty filter to this list. For each item, ask yourself 2 questions. First, could I lecture a class of graduate students on this topic for an hour without preparation? Second, if I were given $10 million, could I confidently start and run a business in this industry? If the answer to either of these is a hesitant maybe or a no, cross it off the list. Be ruthless. The third step is to draw a circle around the very few items that remain. This is your circle. It might be surprisingly small. That is not a weakness, it is a strength. The final step is to commit to deepening your knowledge cruising that circle, not expanding it. Your goal is not to become a generalist. Your goal is to become the world's leading expert on the 2 or 3 industries and the 5 or 6 companies that lie within your circle. Read their annual reports, study their competitors, listen to their conference calls. Go deep, not wide. This is how you build the foundation of knowledge required for high-conviction decision-making. The path of the 99% is the antithesis The path of the expert in everything. This is the investor who has an opinion on oil prices on Monday, a hot take on biotech stocks on Tuesday, and a prediction about the future of cryptocurrency on Wednesday. Their knowledge is a mile wide and an inch deep. They get their investment ideas from headlines, from social media, and from the most active list on their brokerage app. They are perpetually chasing whatever is hot, whatever has a good story. Their portfolio is an incoherent collection of lottery tickets. They might own a Chinese solar company, a Canadian cannabis producer, and a Silicon Valley software-as-a-service firm, without a deep understanding of any of their business models. Because their knowledge is shallow, their conviction is fragile. At the first sign of trouble, a bad earnings report, a negative news story, they panic and sell because their investment thesis was never built on a solid foundation of understanding. They are doomed to a cycle of buying high on hype and selling low on fear. They violate the most fundamental rule of investing: never invest in a business you cannot understand. Their constant activity and broad diversification are not a strategy. They are a substitute for the hard intellectual work of building genuine competence. The direct financial connection between the circle of competence and your bottom line is the concept of the asterisk margin of safety. This is Ben Graham's most famous principle, and it is the cornerstone of value investing. A margin of safety means buying an asset for significantly less than your estimate of its intrinsic value. It's the buffer that protects you from bad luck, errors in judgment, or the unpredictable vicissitudes of the economic world. But here is the crucial link. You cannot have a margin of safety without a circle of competence. Why? Because the entire concept of a margin of safety is predicated on your ability to calculate a reliable estimate of intrinsic value. If you are investing in a biotechnology company and you don't have a PhD in molecular biology, any value you calculate is a complete fantasy. It's a guess, not an estimate. You have no real idea what the company is worth, so it is impossible for you to know if you are buying it at a discount. You might think you have a margin of safety, but you don't. It's an illusion. It is only when you are operating squarely within your circle of competence, analyzing a business you deeply understand, that your estimate of intrinsic value has any credibility. When you know an industry inside and out, you can project a company's future cash flows with a reasonable degree of confidence. Only then can you compare that value to the current stock price and determine if a true margin of safety exists. The circle of competence, therefore, is the ultimate risk management tool. It reduces the risk of permanent capital loss far more effectively than broad diversification ever could. It allows you to make large, concentrated bets, not because you are a risk taker, but because you have done the work to reduce the risk to a negligible level. That is the final promise of this entire philosophy, that the path to immense wealth is not through taking bigger risks, but through developing the discipline, patience, and knowledge to wait for the rare moments when you can act with near certainty. You have just invested your most valuable asset, your time, into rewiring the very core of your decision-making process. You've moved beyond the shallow noise of hustle culture and action bias and have been given the blueprint for a more powerful, more deliberate way of operating. You have seen that true financial power comes not from frantic activity, but from the profound discipline of selective inaction. This is not just a collection of tips, it is a complete mental toolkit. You now possess the framework for building a temperament that is immune to market panic, a system for making only high-conviction decisions, a mindset for hunting opportunities in chaos, a strategy for weaponizing cash, and a method for building the intellectual certainty that underpins it all. You have acquired an advantage that 99% of people will never discover. But this is not the end of the journey. What you have just mastered is one crucial, foundational network of ideas within Warren Buffett's complete mental arsenal. Think of it as learning the rules of the king, the most powerful piece in the game of chess. It's a massive advantage, but it's not the whole game. The true genius of this system lies in how these networks of ideas connect and reinforce one another, creating a latticework of mental models that is nearly unbeatable. The principles of selective inaction are exponentially more powerful when combined with the principles of business valuation, or the deep understanding of competitive moats, or the psychological models for dealing with management. Each piece you acquire makes every other piece you hold more valuable. The video that is now appearing on your screen is not a random recommendation. It is the next piece of the map. It is the link that connects what you have just learned about TOPS when to act with the deeper knowledge of Clonanas to act upon. It represents the next layer of the latticework, the adjacent model in the system that will lock in and amplify the power of the tool you just acquired. The choice to click is not about watching another video. It is a decision about your own identity. Are you a passive consumer of information, or are you an active architect of your own mind? Are you content with a single weapon, or are you committed to building the complete arsenal required for true financial sovereignty? The path forward is there. The next link in the chain is waiting. Continue your ascent.